Please welcome our next panel, 2025, the next chapter for interest rates, navigating your loans in a challenging landscape, featuring John Kautz and Mark Perlow.
Okay, we're live. I think we're live. Hold your applause.
Starting?
We are ready.
We are ready. Okay, excellent. Well, thank you everyone for joining. This is like the graveyard shift, as we call it. But those survivors, the iron men and women that have trooped through the conference thus far, we appreciate it. My name is Mark Perlow. It's nice not to have the badge around me for a second. So I am a director at AST Defeasance and Rate Caps, where we offer clients hedging advisory on floating rate debt and fixed rate debt, along with prepayment consultancy in regards to Fannie, Freddie, and CMBS debt, such as defeasance, as the name implies, but also yield maintenance and any of the more complicated pay downs of commercial real estate debt. I am joined today by John Kautz, a seasoned veteran of Wall Street. He's been on the street for over 35 years. He has seen it all, to say the least. But we are honored to have John come aboard RCA about 4 years ago and help build out our derivative advisory business. And it really has grown considerably since then, but it's a pleasure to have him here. Really, it seems to me, in a joking way, but when he talks, the market listens, because he puts his thoughts on paper. I don't know how many of you get our emails or anything like that, but he puts his thoughts on paper, and we're able to look back and see correct, incorrect, and so far he has a pretty good batting average. So we appreciate him being here. Okay, I feel like I have to take a deep breath, because 2024 is ending soon, hopefully. But my concern, obviously, is that just because the number changes from a 4 to a 5 doesn't necessarily mean that everything's going to be getting easier or better. But we hope so. That's the plan. For today, what we want to do is keep things simple. We're not going to sit up here and pontificate. We're not going to tell you what is going to happen. We could only tell you based off what our experience is, what our clients are telling us, and try and make it in a digestible format. With that being said, the goal is to take a couple minutes, go through what we saw happen in 2024, then tell you guys what we expect to be likely to happen in 2025, along with how President-elect Trump's surprise, somewhat election victory has changed our expectations of what will happen in 2025. And I can tell you that this slide, when we go through it, is fresh, because we had a slide on what a President Harris would do to 2025 in rates. So we had to tear that on up, and we had to put a new one in. And then after that, we're going to go through 4 case studies, very basic case studies of real-world examples of how to mitigate interest rate risk, both on the floating side and on the fixed rate side. So that's the game plan for today. We're going to try and get through it and leave ample amount of time for questions at the end. Okay, so in terms of 2024, I'm going to kick it over to you, John. Tell us a little bit about what happened, why it happened.
Yeah, thanks, Mark. And thanks for attending today. It's really a pleasure to be here. I'm a veteran of this conference. I love this conference, so it's a pleasure to be able to speak to you this morning. As Mark mentioned, 2024 was definitely a bit of a bumpy ride for rates, I think, as we all know. Behind me, you'll see the slides. And I think what I wanted to really impress on everyone this morning from 2024 is the tremendous amount of volatility and changing expectations that we witnessed, and how that can impact rates very quickly. So the top graph that you're looking at there are Treasury rates that are year to date from the beginning of 2024. You can see at the far left of the graph, initially rates had popped up as we headed into year end. There was some uncertainty on when the Fed would begin cutting interest rates. That pushed rates a little bit higher. As we got into the middle of the year, speculation changed that the Fed would indeed be moving, to an easing bias and reducing interest rates. The problem with that was the economy and the information that we were getting in terms of economic data was not cooperating with that scenario. Despite many calls for a significant slowdown in the economy, even recessionary talk that we heard often, none of that materialized. And in fact, we saw the opposite. We saw strong growth. We saw resilient consumer spending, and we saw a job market that was almost bulletproof. Yes, we saw some signs that that job market was cooling off from the super tight levels that we had post-pandemic. But by all indications, the economy was doing quite well, which was going to make it difficult for the Fed to cut rates as much as the market anticipated. And that's why you see, as we get to the middle of the top graph there and towards the right of the graph, and I'm pointing at my monitor, but you guys can look to the left or right here, we saw market expectations adjust. And we saw market participants dial down rate cut expectations. When that happens, we tend to see Treasury rates react and move in accordance with the new expectations. So as rate cuts were removed from the curve, rates started to ease back up. And one of the main things that I want to leave you with today is, again, the Fed can only control the very short term part of the curve, the very short end, overnight rates and overnight benchmark funding rates. Basically, the rest of the market, in terms of the yield curve, say 2 years to 30-year bonds, and mostly the 2 to 10-year sector, reacts to what those rate cuts are going to do. Now, on the far right of the graph, kind of the three-quarter mark, you can see rates start to drop. That was, again, the market kind of caught this fervor that the Fed was again going to be prompted to cut rates. At one point, the market expected over 175 basis points of rate cuts this year. And I think, as we all know, we clearly did not get that. As we approach the election, and more importantly, after the Fed cut rates 50 basis points in September, they signaled that another jumbo cut probably was in the cards for this year, and they also signaled that they were going to need some more incentive to aggressively cut rates this year. So as such, market expectations adjusted, rates came down. As we move toward the election, and despite the fact that the polls that you would have seen were very balanced, a deadlocked race between the two candidates, the market did not feel that way at all. From very early on in the year, and particularly as we moved through the campaign, market participants were for some reason convinced, or growing more convinced, that Donald Trump would win the election, as we saw him do. So as that happened, anticipation of perhaps some of his new policies and how that might impact the Fed's activity pushed rates higher, and that's kind of how we ended the year. Now, keep in mind, that's despite the Fed cutting rates again at the November meeting. The bottom graph represents what we call the yield curve. If you look at the top yellow line on that graph, you'll see where we started the year with the yield curve. You can see that it is a significantly inverted curve with short-term rates much higher than long-term rates. But as you can see, as Fed rate expectations were built into the curve, and more importantly, as the Fed actually cut rates, those expectations adjusted the curve. And you can see the massive flattening, or disinversion of the curve that occurred throughout the year. The green line is where we were sitting on Friday when I made my latest update to the slides. Again, you can see we still have an inverted curve, but to a much less severe degree than we had had for a number of years, and rates kind of settled down. But the important thing I want to point out here is that if you look at, again, at the middle to right part of that bottom graph, you'll see that term rates did not go down in tandem with the Fed. And in fact, they moved up as the curve kind of flattened from the long end. That is, again, directly attributable to the shifting rate cut expectations and the fact that the market was unsure about what the Fed's plans were next, and I think that's kind of where we're sitting now. So 2024 really characterized by volatility, massive shifts in rates relative to other rates, as we've seen in terms of the curve shape, and again, that flattening of the curve. Mark?
Yeah, thank you for that. I think it's important because of the amount of questions we get from clients is now the best time to trade? I think that's the number one, and any brokers here and even owners themselves, they're always asking themselves that question. And when you're seeing these graphs, especially the one on the top right, you could see pretty clearly that that's an impossible question, because look at all that movement. And it highly depends on where you are on that curve, and we don't know where we are on that curve relative on a yearly basis until we get to see it so far out. So as we are sitting here looking at it, I think this is the answer that we should all be telling ourselves, is we have no idea if now is the right time to trade or not. What we could tell you is that risk mitigation and trying to play the market are inherently oxymoronic. They're impossible to do together. And you need to break those two themes away from each other to make the proper choice, which is we don't know what's going to happen. This is not, buying Tesla, buying Bitcoin, seeing where it goes tomorrow. There's a lot riding on a commercial real estate transaction. This is not a $5,000 trade. You buy a couple shares, you maybe do a call option, a put option, something like that. It has to be risk mitigation. That always has to be where it's coming first. So the best time to usually buy a cap is the time that you're thinking about buying a cap. If it makes sense at that point, if the numbers pencil out, that is going to be the time that you should do it. Because if you don't, usually there is much more regret on the potential downside of not doing so than a week later being able to sleep that entire week and being like, oh, I lost 20 grand. Which, again, 20,000 is something, but it is far less concerning than if you have investors and you don't pull the trigger and suddenly you need to ask them for more capital. So again, do not treat any sort of these derivative options and hedges as your next Bitcoin. We don't know what is going to happen. The safest thing you can do is to keep it in perspective. And with that being said, I pulled this morning, I wrote down over here, if you were looking at a 1-year cap, right? Interest rate cap, very vanilla. Most of us here have dealt with them before. If you were looking and you were asking me a year ago, how much is a 1-year cap going to be for January 1, 2025 to January 1, 2026, 50 million at a 2% strike rate. Last year, if you were looking at, where is this? 916,000. So if you would have bought it 12/31/2023, it would have been, for the next coming up year of 2025, it would have been 916,000. If you would have purchased it June of last year, so only 6 months ago, it would have been 1.2 million. If you would buy it today, it would have been 1.13 million. So again, it would have been the most expensive 6 months ago, it would have been the cheapest 12 months ago, and the middle ground is now, which is basically telling you there's no rhyme or reason. And if you look at different strike rates, that will change considerably. The higher the strike rate, the more out of the money the strike rate is, the cap is, then the more volatility the further out you go. So it would have been much more expensive a year ago to buy a 5.5% strike rate than it is right now. So overall, to keep in mind, typically when you're ready to lock, lock. When you have questions about whether this specific strike rate makes sense to lock now, ask us. That would be the two pieces of advice that I would have. That's really talking about 2024. What are going to be, you think, the main items at play in 2025?
Yeah, no, that's a good segue, because I think that's a great point Mark made. The trying to time the market is often contradictory with your objective, which is to mitigate risk. So the longer you wait, the more indecisive you are at times, the more open market risk you're taking. Segueing into 2025, and I think just to start this off, I'll say, one of the things I've learned during my career is forward curves and forward predictions on where rates are going to move rarely, if ever, manifest themselves as forecast. So keep in mind and take it with a grain of salt that forward curves can change very quickly depending on what's going on in the market. Just taking a look at this next slide, I just kind of wanted to visually show you what the market expects next year for Treasury rates, which would in turn impact swap rates and cap premiums as well, in large part. If you look at the top graph, that is the 2-year, 5-year, 10-year forward Treasury curve for 2025. These are not my projections. I kind of culled these from many different sources and put together a combined forward forecast. And you can see that despite all the talk of, wow, rates are going down next year, we're going to see an improvement significantly in rates, that's not currently what the market is forecasting. In fact, you can see that the market is forecasting right now barely any movement in treasuries next year. That's for two reasons. Number one, with the curve flattened, it just shows that the market is uncertain. Typically, when you have a flat curve rather than a normally upwardly sloping yield curve or an inverted curve, which is typically a sign that the market thinks a recession is coming, the market is uncertain and unsure about the path forward for rates with any conviction. And that's what we see right now, is what we showed on the earlier slide. The curve is flattened out. The projections for treasuries next year are to remain kind of flat. Now, again, I expect that to change. And I expect that to perhaps change significantly depending on what President-elect Trump is able to implement in terms of his policies, and we'll talk about that in a couple of minutes. But I really wanted to leave you with the feeling right now that in terms of term rates, at the moment, rates are not expected to move dramatically. And remember what I said about the Fed really impacting the very short end of the curve. So the Fed can still be active, and I expect they will be, reducing rates next year. That, of course, again, depending on some of the policy impacts that we're going to see. But we, right now, expect Treasury rates to just kind of hold constant. Again, I'll talk more about that a little bit later on when we talk about the potential impact of President-elect Trump's policies. The other thing to keep in mind is, what does the Fed have planned for next year? There's a tremendous amount of uncertainty. I think initially when the Fed reduced rates 50 basis points in September, the market breathed a bit of a sigh of relief. We finally got that rate cut we've been waiting for. And it was actually a little bit more than the market bargained for with 50 basis points for a long time. It was thought that they'd just start off 25, but they figured they'd start out with a bang. And really try to reset that, recalibrate, as Chairman Powell is fond of saying, short-end rates to start to move closer to their terminal rate, as you hear about, or the neutral rate, where there's kind of an equal demand and cost for credit, if you will. That's kind of what they mean when they say the neutral rate. However, many things have changed since then. We've continued to get strong economic numbers. We have continued to see inflation, although it's a bit sticky, which is a concern, and we'll talk about that a little bit later on as well. We have seen, by and large, inflation contained and moving in the right direction. Again, the last couple of numbers we've got were a little bit stickier than we would like in terms of core inflation, but nothing yet that I think is setting alarm bells off for the Fed. However, it was enough to get Fed officials to start hinting lately when they were speaking, and most prominently Chairman Powell last Friday, to say that the economic data is not presenting a compelling reason for the Fed to cut rates at a extraordinarily quick pace. So I think what we can expect for the Fed from the Fed this year is what we're kind of referring to as slower to lower, and I think that's going to we're going to get the first test of that at the December meeting. Because if you look at forward pricing, maybe 3 or 4 weeks ago, prior to the election, you'd look at December and there was maybe 30 basis points of rate cuts priced in, keeping alive hopes that, yes, the Fed's going to cut rates 25, and maybe even more than that if the data presented itself. Now, if you look at those forward projections, I checked this morning, there's maybe 16 basis points of rate cuts priced in. So that's going to leave it at about a 50-50 chance for another rate cut in December. The graph that I'm showing here is basically historical Fed funds to the far right of the graph, and most of it. And then when you see those trailing kind of spider lines there at the end of the graph, those are various expectations. You've got the Fed dot plot up there, which is the yellow box. You've got the Fed funds futures curve, which is the dotted lines. And you've got market expectations, which are how term SOFR futures are trading. As you can see, there's definitely some disparity in what is predicted for the Fed next year. But I think most of market participants, economists, forecasters are aligned that the Fed will continue to cut rates. I think the other wild card that we have here is one of the reasons that the Fed is cutting rates in the face of what is actually a pretty decent economy still is the relationship of Fed funds to the inflation rate. There's too great of a gap between those. Ideally, the Fed likes to have a neutral Fed funds rate very close to where the inflation rate is, so that they know there's kind of a match there, and funding and earnings and everything will keep pace with inflation. So I think regardless of where the economic data goes, and could still have a huge impact on the Fed's decision-making next year, their bias is still to lower rates, move closer to that neutral rate that they talk about, and to align it more closely with inflation. I will say, though, that the Fed officials, and I'm one of those geeks who monitors what the Fed officials are saying and listens to the speeches at night and things of that nature, and there has been a lot of chatter lately about where is that neutral rate. And last year, if you recall, when they used to talk about that initially, people were talking about 3%, maybe even sub-3, 275. Now you're getting a much wider disparity in expectations for that neutral rate. I've heard things ranging from 4% all the way down to that 275 level. So there's definitely more uncertainty in terms of where the Fed is thinking that neutral rate may be achieved. So with respect to the Fed next year, I think if they cut in December, they probably skip the first meeting of the year. Just see where things are going to work out. We'll have our new president in place. And from what I understand and everything that he said, he wants to get to work very quickly. So they'll probably skip the next meeting. But expectations are calling for Fed funds to be approximately, say, 350 to 375 by the end of 2025. And I think most market participants are still sticking to that forecast.
So, John, just to take a second, to break out the expectations versus what's expected from the Fed funds rate, we have so far seen market expectations be wrong in what they thought that the Fed was going to do. As we always say, don't fight the Fed. It seems that the market has tried to fight with the Fed on several occasions over the last 18 to 24 months, even before the Fed started hiking rates, and they've lost every single time. So do you think that the 350 is realistic?
Well, again, I don't mean to be evasive, but I think that is going to depend a lot on the impact of President-elect Trump's policies. Right. Because right now, we're at I don't want to say crossroads, but a very sensitive time for the market. Because typically you may have one or another factor impacting the market, but right now we have economic, political, monetary policy, and geopolitical factors all impacting the market and all having a potential impact on rates. And as Mark pointed out, that forward curve is rarely right, which is another reason, again, to take advantage of markets when you're ready and not to be indecisive, because many of our clients at times are under the mistaken impression that rates will move when the Fed cuts. The only rate that will move at times, depending on the message they send after the meeting, will be the overnight Fed funds rate. So keep that in mind, when you're making your decision. If the market is anticipating rate cuts, and we advise our clients on that all day long, and what those expectations are, you need to take advantage of that at that time. Because what that means is that rate cut's priced in. The risk to you is that the Fed does not do what they anticipate and the market adjusts suddenly after the meeting, and that's where we see sometimes clients being on the wrong side of the rate market move.
And what we've heard, obviously, is that one of the most common things that we've been hearing is, President-elect Trump, he's a commercial real estate guy, so he's going to do whatever he can for, not necessarily selfishly for his own portfolio, but it's something that he's well aware of, he's well attuned to, and he's going to want to definitely help the commercial real estate market. However, also from what he said during his first term and some of the things he said on the campaign trail, it doesn't seem that the policies he is aiming for is going to help the commercial real estate market. If anything, tariffs and things of that nature will inherently cause a resurgence of inflation, and with that, higher rates. So what do you feel is simple political rhetoric versus the actual policies he tried to do in his first term, not necessarily from that political stance?
Yeah, no, listen, I don't think it's rhetoric. I think President-elect Trump wants to leave an impact and have an impactful legacy. And he has said a lot recently that he wants this term of his presidency, and perhaps when we look back at his first term, to be about delivered promises. That tells me that he's going to get to work pretty quick. And with a majority government, he's going to be able to push the policies that he wants through in most cases. Now, what are those policies? And let's talk for a minute about some of the pros and cons. Some of the pros would be deregulation is typically good for banks. If you can make it easier for banks to operate, that generally increases lending appetite, which is good for borrowers and for investors as well. And you know, what we also might see, and what tends to happen in an environment where lending is increasing and banks are more active, is competition increases amongst banks. And what does that mean for you as a borrower? That means credit spreads compress. And that's really what we need to see as well. We'd like to see credit spreads come down from, let's be honest, the elevated levels they've been at for the last few years. So that's a pro. He's also been on record, as Mark alluded to, as wanting to help this long-awaited housing market recovery, encompassing anything from personal home residences all the way up to the commercial real estate concerns that most of the people in this room deal with every day. So he may be trying to do things by providing incentives, making it easier to borrow, or under some of the federal programs that are available for commercial real estate participants. That's a positive as well. Lower taxes. He has mentioned that he hears us, and he is going to try to relieve some of that property tax burden and other taxes that are associated with the commercial real estate industry and the borrowing that goes on there. And that would also be a pro for a market. If he is able to stimulate the economy as he hopes, that's going to increase demand, and that's also going to be a positive, in my opinion, for commercial real estate by driving demand and hopefully having people having more disposable income to look at maybe a change in a housing scenario or a new investment in a property or those types of things. These pros and cons are not meant to be my political view. Again, I've just tried to cull what I'm hearing from market participants and things. So the cons, I will say, have me a little bit more concerned than the pros. Deregulation, tax cuts, and I think most importantly, these tariffs, all can have a tendency to fuel inflation. And unfortunately, again, very unfortunately, we had the pandemic strike kind of, right in the middle of Trump's presidency, if you will, toward the end of that. And we didn't really get to see it develop much because the pandemic kind of shut things down. But there were already signs that inflation was going to move higher based on some of the tariff policies that President Trump put in place. Obviously, aggressive tariffs, if they continue, and if our trade partners don't capitulate and we get into trade wars, people who are importing, exporters, they are going to pass that price increase onto consumers. That's going to lead to inflation. And it could lead to a bump in inflation very quickly, which we have seen in some past administrations, say throughout the last 40 years, where high tariffs tend to generate inflation. So do lower taxes. More income for people to spend drives up demand, tends to raise prices. So inflation, I think, would be the worry that could potentially kind of throw cold water on the optimism that many people are feeling in terms of Trump's policies and the stimulation of the economy, tax breaks, keeping the job market humming along, those types of things.
So the hope is, correct me, is that even though inflation may go higher, if Trump could stimulate growth, then that should maybe negate some of those negative consequences of inflation. And additionally, even if he can't, if he does maybe take some of the shackles off the banking industry with deregulation, that'll bring lending back into the market, which will also help refinances and everything such as that.
Yeah, no, that's absolutely right, because again, there is a way to offset inflation with economic stimulus. The thing that has me concerned there is, again, a 2.8 GDP for third quarter, and the Fed is anticipating it to stick around there, maybe even tick up higher in the fourth quarter. So sometimes you reach kind of a terminal point there where too much stimulus overheats the economy. So whether it's inflation or too much stimulus, in both cases, the Fed's answer to that is to raise rates, either to slow down the economy or to combat inflation. So yes, he can walk that tightrope where perhaps he's able to keep the economy stimulated enough that inflation doesn't take root, because with a stimulated economy, the supply and demand side of the equation will equal out, right? Economy's cranking along, suppliers, producers, manufacturers, service industry, that's cranking up, and so is the demand for those services.
Excellent. Okay, so that really covers from the perspective on a macro level from what we've seen in the market, what we expect to see in the market. And I think that the common theme, obviously, in this conference, based off the panels that I heard, was there's a reset to what normal is. So it's as you guys, everyone here is thinking about their portfolio or helping clients and guide their clients, it's really important to stress what is normal. Normal is not what we have seen over the last 3-4 years. Normal is, on a broad spectrum, is that 5% lending rate, things of that nature. Going down to the COVID rates is not something that we should be expecting, and it's not something that should be relied upon either. Okay, so what we want to take a moment to do, as we're cutting it close on timing, but what we'd like to do now is go to more of a micro, which is go through 4 quick examples of different hedging strategies that could be employed both on the floating side and on the fixed rate side, where they come into play. We're going to cover it in a really, I would say, a broad view. And obviously, if anyone has any questions after, we could always dive more into it, either at the conference or always after. So the first one that we should discuss, I think, John, are loan floors. So again, everyone is very aware nowadays what an interest rate cap is. It's funny, the first time we were at eCore, maybe 4 years ago or something, it was the annoying line item that everyone wanted to negotiate away, and they couldn't handle the $10,000 that a cap might have cost them back in 2020. And why should we get a 3-year cap? Let's get a 2-year cap. Maybe we could squeeze the lender for a 1-year cap. I think that we could all agree that anyone that lost that negotiation is sitting here very, very happy that they lost. And the reason for that is because what the market expects is what the market expects, and there's not much to that. That if everything happens the way that the market is saying it will happen, then obviously it never makes sense to buy protection or to hedge yourself. The point of a hedge is because you are going against what the market expects, because you are seeing through some of the noise that the market is telling you. So with that being said, let's discuss floors, the opposite of what a cap is, and how it could be employed.
Yeah, no, let's dive right in. Look, I think with the tremendous, increase in rates that we had seen prior to the Fed beginning cutting rates in September, created a situation where many borrowers were stuck with high loan floors, 4%, 4.50, and that obviously is a concern when rates are dropping because you get floored out on your loan and you're unable to benefit from lower interest rates. The hedge product that we want to talk about right now is an interest rate floor. As Mark mentioned, the opposite of a cap. Instead of getting paid when rates go above your cap rate, you're getting paid when rates go below your floor rate. And keep in mind that when you're talking about hedge products, they can be structured to a highly specific objective if you have that in mind. Or they can be used more as that insurance protection where, I'm not really sure what's going to happen, but I can't really afford to be wrong, and I don't want to be. So there is a lot of flexibility in terms of structuring these hedge products that we're going to talk about. In the example that we're looking for here, this was a client who had a restrictive loan floor at 4%. Fortunately, they did this right before rates started to drop, so they got a very attractive premium on their floor. What they decided to do was to buy an interest rate floor separate and distinct from their loan, has no real impact on the loan whatsoever, at the loan floor rate, so say at 4%. So what happens in that case is, like a cap for an upfront premium, depending on how tight you want that coverage, in this case the client purchased it right at the loan floor. We have some clients who look below the loan floor. They're willing to give up a little bit of that benefit, but let's say rates are really going to start to move down. They want to make sure they can participate in that. So for the $144,000 premium, this client bought a 2-year floor. What happens is, in the event that SOFR resets below 4% at any time throughout the life of that loan floor on any given reset date. And rates are lower than that 4% strike. Let's say they do go down to 350 and just sit there for a while, which incidentally is when this product works the best. If rates go below your floor and just kind of sit there, you would be paid that 50 basis points for as long as rates stayed below that floor. So synthetically through the derivative, you're able to participate in lower rates even though you are floored out on your loan. You're still floored out on your loan, but you know that floor payment, if you will, that you're going to make, or the floor rate that you're going to pay to the lender is going to be partially offset, depending on where you strike the floor, by the floor payments that you're going to be receiving under that derivative.
And it's important to also just mention that this could be done on fixed rate debt too. This does not have to be done necessarily on floating rate debt. You could also be taking a position on the market.
Correct.
Where if you are even in fixed rate debt and you're concerned about why should I lock in a 5-year Fannie deal that has a restricted lockout, if in a year from now suddenly loan floor is going to be less, I could have refied and gotten a much better rate, you could buy a loan floor such as this, again, that opposite of a cap that will pay you out. So you could stay in your fixed rate debt. You don't have that pressure to refinance because it's still synthetically a market rate loan. Okay, moving on to number 2. Obviously, we've seen a tremendous disinversion of the yield curve over the last couple of months, which is something that we really haven't had a healthier looking yield curve in some time. So what strategies could we take from that perspective?
Yeah, thanks, Mark. I think, right now with the flat yield curve, it still tends to favor swaps and caps as hedge products. And as you can see from the top box, and hopefully you can see it okay, that really kind of illustrates how flat the curve is as well, how flat the swap curve is. Because, yeah, there's maybe 20 basis points of difference between the two. And you can see the back end of the curve there, 5 and 10-year rates, are right on top of each other. So what the flat curve offers you is the ability to hedge longer term, which may, again, help you sleep easier at night. It helps you to manage debt more dynamically if you'd like to move out farther on the curve. So many times we'll have a client who'll come in and they may have a longer facility, say a 10-year facility, and they're maybe looking to hedge it for 3 to 5 years. However, if they find out and when they see that those 10-year rates are basically right on top of where the 5-year rate is, there may be incentive to move out longer on the curve and protect yourself for a longer period of time. It's a similar concept for caps, because a common misconception that our clients make is that cap prices or cap premiums are driven by SOFR rates, by the overnight SOFR rate. That is not the case. Cap premiums are a function of rate volatility, how fast and how much rates are moving, and term SOFR swaps. So if you have a 2-year cap, the thing that we look at and would track for you would be the 2-year SOFR swap. So similarly for caps, and I'm conscious of time here, so I'll move along, you're getting good relative value where, wow, expectations are here for that forward curve. So again, rather than maybe do a 1-year or a 2-year cap and escrow and have that, to manage and it's going up or it's, as rates are moving, you might decide to go ahead and hedge that 3-year cap because the relative value in moving out that additional year is very attractive when the curve is so flat.
Excellent. So now there are 2 different types of swap options I think we should discuss. John, do you want to just dive into the first one?
Yeah, we'll dive right in. Another thing we have our clients ask us questions about a lot is sometimes, and even with our name, Rate Cap Advisors, people think it's just a liability, SOFR type of, variable rate hedging environment and product availability. That's not the case. If you have fixed rate debt that's coming up and you are worried about the direction of interest rates, there is a way to hedge that. There are 2 ways to hedge that, actually. One is just a straight treasury lock, and I'll just speak very briefly about that. You lock in a rate, but the problem with that is, which a lot of our clients want to avoid, is there's a 2-way settlement on the day that that treasury lock settles. So if you lock your 10-year treasury at 4% and rates go to 3%, you're paying away that 100 basis points of benefit to the T-lock provider because you're locked into that rate. Yes, if rates go up, you'll be compensated, but many times our clients do not like the possibility that they would be able to, they'll have to pay away all of that benefit. So the way we see a lot of our clients hedging future fixed rate issuance is via a swaption. Now, don't let the name fool you. What you're simply doing is, like a cap, you are buying a premium-based product at a strike level, but the strike level we are choosing is going to be the Treasury rate. And that depends on what Treasury rate that you're looking to hedge. 10-year, 5-year, it doesn't matter. There's an active swap market for all of the above. You pay an upfront premium if on the day, or you can execute it prior to your expiry period. So let's say you have a fixed rate issuance 90 days in the future. You'd buy a swaption with a 90-day expiry, meaning you're protected for that next 90 days. You pick your strike rate. Many times people pick them right at the money where Treasury is trading right now. Some people want a little bit of room because they're not as sensitive to rate movements. But basically on the day that the swaption expires or before, they measure where the Treasury rates, or in this case the swap rate since it's a swaption, but swaps and Treasury rates are directionally very closely correlated, so it's usually a very effective hedge. You get to that expiry date. If those rates are higher, you get paid the difference. The value of that payment basically offsets your higher borrowing cost. Because keep in mind, we're buying an option on a 3-year swap, so the way they are structured is to model up to the underlying sensitivity of your loan. So as you're thinking about your forward rate loan, forward fixed rate loan, and you say, okay, if rates go up 20 bips, how much does that cost me? If rates go up 50 bips, what's that add to my interest expense? The swaption that we're using to hedge is structured to match that underlying sensitivity. So again, this can be a very effective way to manage future fixed rate issuance.
The most common way that we see this and that our clients ask us for this is actually on defeasance. So again, just a really quick 30 seconds. You have defeasance, you have yield maintenance. Defeasance is commonly found on Freddie Mac and CMBS debt. Yield maintenance is Fannie and Lifeco loans. They get you to the same place through vastly different processes. Defeasance is not a real payoff of your loan. It's a substitution of collateral, where we're taking your property that's been securitized, we're replacing it with treasuries. The bondholders never realize the difference. The payments are still being made at the end of every month due to the twice maturing treasuries at the 15th and last day of every month. So what happens a lot, though, is that when you're talking about a defeasance, the overall process is that, especially on a sales side, where you are going into contract, and between contract and closing, the cost to defease your loan is going to be dependent on treasuries. And when you have 60, 90 days in between signing that contract and closing, the rates can move greatly against you and have the possibility of what made sense no longer makes sense in terms of the sale. So one of the ways that you could mitigate that risk is through a receiver swaption, which is basically, again, you could see on the graph over here on the table where, if you would like to pay $237,000 basically for the swaption premium. In this case that we did for our client, rates moved 51 bips against him from going into contract to closing. So the receiver swaption came in and paid at the expiry $832,000. So the net benefit to the client was $595,000. Now that is a considerable amount of money. That made the deal still make sense. If you didn't have that protection, suddenly the client's defeasance is going up around $800,000, $850,000. There goes possibly your entire profit margin on the deal. And there goes any deal, any semblance of making sense. So obviously, it is always going to be, we always let clients know that this type of product doesn't make sense if you're trying to save yourself $10,000, 10,000, 20,000, 30,000. This is what we would call like catastrophic care. Like if for some reason rates blow out, as you see over here, a 51 basis point of movement, that's where you're going to protect yourself because of the upfront cost of the $237,000 that it costs in order to actually get the option in the first place. That covers everything. We still have a minute left, but that covers everything we wanted to get through today. Thank you everyone for coming, for joining. Hopefully everyone learned something, and we'll open it up to any questions if anyone has. Yeah.
I just want to ask a question. The question is, let's say I'm a borrower and I got a interest rate cap expiring next 3 months. I'm debating to refi because I don't want to purchase a cap extension. I know they're pretty pricey nowadays. What would you recommend as a borrower if my cap is expiring soon? What should I do?
So it depends on the likelihood that the refi is going to happen, which means that obviously if a refinance is very likely, then you're going to have to play the market a little bit. But some people are hopeful optimists. And they know deep down that a refinance is not really an option. And then it just comes down to mitigating risk now. So you got to be honest with yourself. How likely is the refi? And should you mitigate the cost now? And it's important to keep in mind that caps retain value. So even if you buy the cap today and you end up refinancing in 3 months from now, you still have a value in the cap that you could terminate. The cap is not connected to the underlying loan. There's an agreement in terms of where the cap payments are going to go. But once the loan is paid off, the cap is your asset to do with as you see fit.
Yes.
2 questions. The 10-year Treasury just 60 days ago was in August 365, and we locked a couple of loans over $40 million and closed, and now we're trying to do another refi. But all of a sudden, since Trump got elected, the rate, the 10 years at anywhere from 4.3, 4.5. Now I heard 2 explanations. A is the anticipation of inflation because of tariffs, and B is that there was a Trump rally where people took money out of bonds and started to invest it in stocks. Is it both of those factors, or is it one? I mean, how do you explain this disparity? It's very hard to comprehend, the run-up has stayed up there.
Well, I think you understand it perfectly, because I would say both of those factors were kind of the perfect storm for sending rates higher. Because as we saw, the reaction in the equity markets to President-elect Trump's winning the election was incredible. I mean, it was one of the best days ever for the stock markets. So I think it was the combination of fears of the policies maybe not being as friendly to the economy as maybe anticipated, and creating higher inflation, coupled with that reallocation, if you will, of investment proceeds from bonds into equities, definitely attributed to.
So when do you
rates.
think the 10-year will settle down to where it was? Is it going to go down to below 4 like it had?
Tough to say. Difficult to say. I think we won't really see a clear direction until President Trump's in office a few months, and we get to take a look at what his policies are. And I think that's why that Treasury curve I showed is just so flat right now, because people are in a neutral position just kind of waiting to see what's next.
Okay, and secondly, all the guys who bought in 2022, 2023, and they got 85% leverage, debt fund, had a cap, didn't have a cap, there was all this anticipation, there's going to be blood on the streets, there'll be so many deals for sale, and guys had to pony up a lot of money every month against these cap reserves, Fannie and Freddie, but we didn't see that avalanche of deals. How do they hold on to all these properties?
Yeah, that has amazed us as well, because you're right. When the Fed was actively raising rates, there was a uproar of, wow, there's tremendous refinancings due on some of this debt in 2025 and 2026, and we got to get rates down or this is going to kill the market. And we haven't really seen that. I think that's partly because lenders got creative and were able to find ways to extend that debt rather than push clients into default situations and things of that nature. I don't know, Mark, do you have any thoughts on that?
I think the creativity you see nowadays is far greater than 2007, 2008, 2009, during the great financial collapse. Lenders are working with sponsors. We're on the phone almost every single day with lenders and sponsors and borrowers. Look, I think that lenders are taking back properties. I just think they're doing it in a quieter way. Because we definitely are seeing cap extensions that the lenders themselves are purchasing, or that are no longer necessary because the sponsor doesn't own the property anymore. So it is happening. I think that unfortunately, and it will happen at a greater rate too as we get further along, because with the maturity wall on a yearly basis, there is no cash to inject to do a pay down of a mortgage or anything like that. So we expect it to continue, but I do think that the reason why it hasn't been to the same pace that we expected was because lenders are a little bit more wary about taking over properties. But I also think it's the lender, which means that we have seen some lenders be far more aggressive in terms of taking over properties. Typically, those lenders that have the ability to do so. It's the ones that have so much risk on their book that it's a domino effect. And it's, if we take one, how do we take 100? But the lenders that see there's only 3 or 4 and they have the capability of taking back the properties, we have certainly seen lenders do that.
Yeah, and I think we're also going to see the Fed continuing to ease rates And I think that's going to help out a lot. I really do, because when the Fed did that first, 50 bip rate cut in September, it was one of the first times we actually saw some, requests for pricing come in for new loans and things of that nature. So I'm hoping that continued Fed rate cuts, and let's hope they stick to the schedule, and there's no reason for them not to, will help alleviate that as well.
I think it also is important to just say, obviously state the obvious, that speak to your lender. The ones that we have seen been in constant communication with their lender, it has been an easier process. It's the ones that think that they don't answer for 3 or 4 months and somehow rates will go in their favor and a cap will dive in pricing by 50% over the next month, where they're ignoring the phone calls and the emails. That's usually when things work out less of the time. So it's be realistic with what you have. The lenders are realistic. They understand the environment that we're in, and if they feel like they have a partner, then usually they're willing to work with that. It's the people that feel that they could outsmart their lenders or do maybe a bully tactic to their lenders. Those are the ones we have seen usually get back to property more often. But that's anecdotal, obviously.
Quick high-level question that I think you guys are in the midst of, based on everything that you touch. Clearly, the 10-year Treasury yield is a lot higher than it used to be in the pre-COVID years. But if we actually break down what the 10-year yield consists of, it's the break-even inflation rate that is like in the low 2s, and then the real yield above that, which is sitting right around 2. And if we think about 2% versus where it's been generally over the last 15 years, basically since the global financial crisis, it's effectively the highest level since that point. What are your thoughts on why 2 is a sustainable level for the real yield as we think forward over the next kind of 3 to 5 years, which affects cap rates for all of us, clearly affects the cost of these various options in the markets that you advise clients on. How do we think about that either going up or down? Because I think that's a big consideration on where the 10-year ultimately lands.
Yeah, no, I think I'd answer that by saying I'm not sure that 2% rate is sustainable. Because if you look back historically, that differential can be a bit wider at times. And I think it's important, and you caveated your question with it, but I think we got very used to a long period of like hyper low rates caused by these black swan events, whether it was the pandemic, whether it was the global financial crisis, and rates just sat at abnormally low levels for a long time. And then coming out of it into the Fed rate tightenings and such that we saw for a couple of years there, the curve disinverted, again, thinking that the Fed rate hikes would push us into some severe recession, which never materialized. So honestly, that's a difficult question to answer, but I'm not sure it's going to be easy to maintain that relationship that we've seen. It could. I would agree with that. Yeah, I would agree. We could see that.
The key word, though, is a year from now when he has the chance to replace him, just because obviously the president doesn't have the authority to do that before the term is over.
No, and that's shaping up to be kind of an interesting
power dynamic.
Sidebar, yes, for next year, which is going to be that, at least perceived right now in the market, conflict between the administration, if you will, and the Federal Reserve. Because the Fed, or rather the president, can't fire the Fed chair. The only way he can dismiss him would be for cause. So if somehow he was manipulating, figures or something of that nature, he can't even be demoted. So we're going to have to wait, and Trump's going to have to wait if that's his plan. And there's also been a lot of chatter about, Trump trying to gain some type of influence in monetary policy. I will say I have a pretty firm view on that, and I think that would be a disaster because I think one of the best parts of the way our country is structured is that separation of the central bank from the controlling arm of our government. So definitely a thing to keep a watch on. I'm sure there'll be some back and forth between the Trump administration and the Fed, but Jerome Powell has shown that he marches to the beat of his mandates, which are low inflation and full employment.
Excellent. Any further questions? We kept you guys all here long enough. We'll stick around for a couple minutes if anyone does.
Thank you, everybody.
Thank you, everyone.